It's November 6, 2024, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, Amazon reports great Q3 2024 earnings. Children's Place partnership with Shein could be genius. The state of SaaS venture capital valuations, and AI platforms looking to challenge every software category. And finally, the Investor Minute, which contains 3 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, Amazon reports great Q3 2024 earnings. The situation here is profit growing faster than revenue, units growing faster than sales, and AWS on fire. A few tidbits. Unit volume is growing 12% year over year based on Q3 numbers. Revenue grew 11% year over year, and online store sales grew 8% year over year. This is one of the highest numbers in the last 2 years. North American operating margin was also up 100 basis points year over year. From the beginning of 2024, Walmart actually called it first. Their plan was to grow profits faster than sales. In an economy you aren't quite sure of, it's a formula where you can control what you can control. And no one was sure they were going to be able to control the consumer. So where is the consumer now? Amazon says the consumer is still looking for deals and is very price conscious. Beyond this, there were themes coming out of Amazon's earnings. First, Amazon is dismantling the convenience store and pharmacy business. Amazon's largest growth drivers are everyday essentials, health, beauty, personal care, and non-perishable grocery. In short, not only is Amazon eating the convenience store, by the way, have you seen the chaos at Walgreens and CVS? Yeah, some of it's self-inflicted, but also, hello, Amazon. Amazon is also eating the middle of the grocery store. And these items tend to be more first-party items. Not coincidentally, first-party units gained against third-party unit share for the first time in recent memory. These are replenishables. It's also the same thing driving frequency and unit volume higher than sales volume. All these items are also more efficiently stored by Amazon in its own warehouses because it has more control over it. Expect this trend to continue because Amazon logistics performance is only getting faster. In one sense, Amazon is finally delivering what quick commerce promised. The second trend here is that this is a once-in-a-lifetime Amazon Web Services opportunity for AI. Just a few tidbits to prove the point. Jassy called this out as this once-in-a-lifetime opportunity. You think Amazon will underinvest in AI? Investors, look out. Capital expenditures ahead. AWS is now a $110 billion run rate business. AWS margins are up to 38%. Just think about that. Their AI business is growing triple-digit percentages and is already a multi-billion-dollar business with demand growing faster than supply. Amazon has gone back to its own custom silicon manufacturer 4 times already to make more. AI inferencing in particular is expensive, and they can save people a lot versus NVIDIA. There's $75 billion in CapEx this year, most of which is AWS, and there will be more next year. Here are a few things I think. Is Amazon getting slower because third-party unit growth is slightly decelerating compared to first-party at the moment? Amazon's advertising business is slowing slightly to 19% year over year. This is the slowest growth in the last 2 years. The last time this happened, they blamed inventory levels. There was really no mention on the call. Amazon's low-cost store is still a hobby, and it's unclear to me how they will surface this. And I wonder if it will be more of a distraction than anything. There's no low-cost store mentioned on the call except that Amazon has said it's always easier to offer low-price selection than it is to be able to afford to do so. You can say that again. No, I won't. Amazon also, based on the recent departure of Tony Hoggett, may never be able to solve fresh grocery. Why Amazon is a mass market retailer bought a specialty grocery retailer, I will never freaking understand. Our second story. Children's Play's partnership with Shein could be genius. If there's one category where everyone understands merchandise that may last less than a week, it's kids. It's through this lens that I analyze the Children's Play's partnership with Shein. The proposition is this: would you accept 1 week shipping from Shein compared to 3 days from Amazon to save 20%? That's what I found browsing the Children's Place on Shein. I found an identical Shein item from Children's Place on Amazon and Shein. On Amazon, the price was $49.95. On Shein, the Amazon price was the strike-through price on Shein, with the promotional price being 20% less at $39.96. Now, before you jump all over me for boosting Shein, consider this. The Children's Place now has 5 pages of items on Shein, hundreds and hundreds. The items are sold and shipped from the Children's Place. The products are actually shipped from the United States. And by the way, Shein's European entity just reported 68% sales growth in full year 2023, and it's hard to believe that number is slowing down in this consumer environment, especially with how committed Amazon is to responding. They aren't ignoring real trends. Although, what's not clear to me is why the ship promise is so slow, especially since these are marketed as quick ship items. Clearly, they're going UPS, but they have to be beating that promise, right? How did Children's Place circumvent Amazon's price matching rules? Likely because Shein's items were greater than $45, and so the item was discounted 20% by Shein's rules, so technically they were on sale. And this was before other Shein discounts are available, including 25% off for buying 3. The consumer is struggling. Shein is adding assortment available on Amazon, beating them on price and shipping from the US, although slower. That's the value proposition. To the extent this becomes the expectation, it could be a hard proposition to ignore. Just like the consumer, retail is becoming bifurcated. If you're a brand giving 50% up your revenue to Amazon fees, shipping yourself a bit slower, having Shein, I'm sure, subsidize some of these promotions, and paying less in advertising, that seems attractive and bears testing. In an era of realignment when consumers are adjusting their expectations, it pays to experiment in places of high volume. Jamie Salter and Forever 21 raised the white flag to Shein in the last 2 years and declared a new era. How long will it take everyone else to do the same? Our third story, the state of SaaS venture capital valuations. One of my favorite sources of data this year has been Clouded Judgment, published by Jamin Ball, partner at Altimeter Capital. It's no secret that post-COVID valuations of SaaS in 2023 had come down to 3 to 4 times revenue multiples due to a decline in growth numbers. This caused a lot of SaaS companies seeking acquisitions to delay their plans. This has stabilized, however. The synopsis is this. For the top growers, if you're growing faster than 25%, you're now worth 11 times or plus revenue. The data on that seems sparse to me because, well, not that many people growing that fast. In the middle of the market, if you're growing 15 to 25%, you're worth back to what SaaS should be worth, kind of 10 times revenue. And if you're going below 15%, you're worth about 4 times revenue. The data calls out a few things. Very few companies growing faster than 25%, which bears out my own experience. When churn is up, the headwinds are greater. And the spread between the middle and the bottom tiers, to me, is the entire story here. The difference between the middle and bottom growers from a valuation point of view is double. If you're looking for an exit or to raise money, this is a critical difference. And if you're a CEO, what should your growth number be calibrated at? My answer is 20%. Mainstream Series A through C SaaS companies should calibrate their growth strategies at 20%. It's simple math as to why, due to the huge valuation difference in being above 15% growth. For many, in the mid-market and enterprise segments, net revenue retention rates are north of 90%. However, SMB is flagging and retention is a major issue. If your net revenue retention is below 80%, it's very difficult to grow, period. And there are only a few solves for this. First, evaluate if your pricing has gotten ahead of the market. If you're in the Shopify ecosystem and have raised prices 2 to 3 times more then Shopify itself has raised pricing, then my feeling is you are in trouble. Shopify is a value ecosystem, especially in the lower, historically strong for Shopify segments. So pricing increases will exacerbate this challenge. Second, consider your innovation. Many companies have forgotten their historical customers in favor of more lucrative upmarket customers. Of course, this is logical to one degree, but it's also a huge mistake to completely ignore your best customers. Every category has more competition and your customers have options. Many customers are voting with their feet. And our last story. AI platforms looking to challenge every software category. Similar to the rise of mobile computing, the tech world is using the latest AI innovations as a moment to reshape the landscape, or at least take aim at it. 15 years ago, the theme was, what if this was mobile first, hit the zeitgeist? The same question is now being asked of artificial intelligence. The results will of course be mixed, but the shots will be taken. OpenAI, for its part, is taking aim directly at Google with ChatGPT search. Can this generational shift add value to consumers? Google itself has partially concluded that it must respond, adding Gemini to many or most searches, so OpenAI is actually making the elephant dance. Perplexity is joining the party, reportedly releasing a pro shop store, which Adweek is saying is aimed at Amazon. While it's notable that Jeff Bezos is an investor in Perplexity, it's unlikely this is directly aimed at the heart of Amazon, especially since Amazon is essentially a very large logistics company. Also, you want to know how I know that someone is not going to be a competitor at Amazon? Mainstream media says they are going to be a competitor at Amazon. That's, to me, is a dead giveaway that someone is not actually going to compete with Amazon. And there's no category of software immune from this overall trend, as it is in the nature of venture capitalists to seek power law outcomes. These sorts of asymmetric outcomes are only possible if this batch of AI startups can disrupt multi-billion-dollar, sometimes multi-trillion-dollar industries. And that means incumbents. The FANG plus Microsoft gang will attempt to defend its own turf at all costs, and of course are investing billions of their own dollars to be part of the revolution, which they cannot miss. The battle continues to play out across MarTech, payments, supply chain, and even e-commerce platforms. Toby Luca of Shopify said on a podcast recently, the future was clear for a while, and it's become cloudy what the outcome will be. Billions of dollars of mistakes will be made in an attempt to fix real problems. But equal amounts will be spent fixing things that clearly also aren't broken. In these moments, innovation and motion is critical. Adoption and flywheels are super important. Meaning, simply having AI in your product is about as useless as having a website. The solution must produce breakthrough value in order to achieve breakthrough outcomes. Founders, business leaders, and even product managers must see past their own smoke and mirrors to the real value driven. Too skeptical of AI? You've got your head in the sand. Too optimistic? It could be a blind alley. Your guide needs to be invention on behalf of the consumer's priorities, wherever they may lead you. It's that time, friends, for our Investor Minute. We have 3 items on the menu today. First, SpeedX founder acquires Accelerated Global Solutions. SpeedX founder Chris Zhang has announced the acquisition of Accelerated Global Solutions, AGS, a customs brokerage and freight forwarder. Both companies will continue to operate independently. Think about it. Now you have 2 businesses that can together generate revenue, as AGS can help brands move inventory across borders and SpeedX can do the final mile. Second, Vitamin Shop owner files for bankruptcy. Franchise Group, the owner of Pet Supplies Plus, The Vitamin Shop, and Buddy's Home Furnishing, has filed for Chapter 11 bankruptcy. The company went private about 18 months ago in a $2.6 billion deal. Still, it has over $2 billion in debt, as its American freight business has continued to be impacted by rising interest rates. Franchise Group will convert 80% of its first lien debt into 100% equity in the reorganized business. And finally, Nexus Capital acquires assets of Intrinsic Brands. Amazon brand acquirer Nexus Capital has acquired the assets of another Amazon aggregator, Intrinsic Brands, which includes 5 brands. Consumer preferences have changed due to the economy, as has the ability of these aggregators to sell products and be able to recoup the investment made in them, has led to brand aggregator sector consolidation. And today's final word of the week for November 11th is affordability. I don't care if you're Republican or Democrat in this last election. Really, I don't. If you've been paying attention to the rise of Temu and Shein in the past 3 years, it's not an accident. And what just happened in our election is not unrelated to this trend. Despite economists saying things are going great, when the incumbents get thrown out on their ear, it generally means the economy is worse than we think and not getting better quickly. Or quickly enough. Brands and the audience need to consider this very carefully. To me, the message is clear. Show consumers you are helping them stretch their dollar and they will reward you with loyalty. In fact, it may be about the only loyalty we have left. Brand is not loyalty right now. Consumers at the moment are asking for loyalty to them in their pocketbooks and rewarding those brands and destinations that respect their wishes. Ignore this advice at your own peril. Did you know that RMW Commerce has a brand new podcast? Check out the Watson Weekend for an unfiltered and lively e-commerce chat each week with me, Rick Watson, my co-host Jess Lasewski, and an array of interesting guests and topics, all focused on e-commerce. You can find the Watson Weekend by searching for it on iTunes, Spotify, or YouTube. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce Consulting and host of the Watson Weekly Podcast, your essential e-commerce digest. Our production partner for the series is Citizen Racecar. The show is produced by Jose Baez. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/Watson Weekly and wherever you get your podcasts.